So in this video, I'm going to show you how to structure a good seller finance deal, how to know when you have an actual good quality deal that'll sell, and how to shoot over a letter of intent to the actual realtor. For this video, I'm going to be using the College of Wholesale's seller finance lead sheet. This is courtesy of the College of Wholesale. For you to be able to find this, you can either go to this link right here or go into our Discord and go into our seller finance tab in the Discord, which is bottommost one right here. For this video, I'm going to be using 1420 Trout Street. I have not actually sent any offer over to this realtor. This is merely just an example property. You could absolutely feel free to send over a offer to this realtor, assuming it's still, an active, not under contract property. Um, Obviously, the first kind of thing you want to do when you're looking for a seller finance property is make sure it's still on the market, it's an active property. It doesn't have, it's not in a contingent phase, not off market. It hasn't been sold. That obviously is the very first step before you even get to, creating an offer for them. Uh, and after that, you really want to talk to the realtor and make sure they're even open to a seller financing type of deal. So, for example, for this property, I would call this realtor, see if they'd be open to a seller finance type of deal, and then kind of move forward from there, creating an offer through what I'm going to show you in this video. Now, a little insider trait or tip I can give you for trying to find seller finance leads would be to go bring this property into a site like Batch Leads. Personally, I prefer Batch Leads, but I know there's other sites like X Leads, PropWire, PropStream. But bring this property into one of those sites. Go to the owner profile and see if it has more than one property that they own. Now, why you do this is because, for example, if they were to sell or finance this property right here, they have another property they can move to as their primary residence. So, you could obviously rent out this property. They could live in another one. They don't have to go search for another one while you're trying to currently buy this property. Now, moving forward, I want to bring this property into one of those sites like Batch Leads. And you first off want to get a rough idea of what the ARV for the property is going to be, the after repair value. Batch Leads gives me a 603 after repair value. Personally, I don't think that is completely correct. I think it's a little bit lower. I think if anything, Batch Leads is pulling this data up here, which is in a completely different area than where my property is. I think my property's ARV is probably going to be near the more mid four, maybe higher five number. A good way to really prove this is by finding a property like this one that I have. This property, this Trout Street property, is a 3-2, 1,300 square foot property built in 1979. A very good comparable property or a comp for this would be the one essentially right next door that sold for 437. And this property went over their listing price, which is a very good sign. It means the property, if anything, will be worth a little bit more, which is why I was kind of going towards a higher 450 number, maybe even five ish. But I want to check for a property around the property that I have, and look for a fix and flip property to run a comp off of. And how you look for a fix and flip property is find one that has. There's a couple ways to go about it. Primarily, how I like to do it is find an ownership length under like a year and a half. Now, I do this because I want to find a property that isn't like one where a family of four moved into, and lived there for a while, and then kind of just put a little bit of money into it, just get rid of it. I want to find one they specifically bought it to fix and flip it. If it's a low ownership amount, it likely indicates that they didn't live there. They bought the property as an investment to flip it. How you back your point on this is by looking through the photos and seeing if it looks recently remodeled. For this property, it looks like new flooring got put in, maybe a couple of coats of paint over different parts of the property. This wall over here kind of looks painted. The living room looks painted. You really just kind of look for what looks like renovations happened to the property on a low ownership length. Now, once I kind of know roughly what the ARV of that property is going to be, I'm going to bring this property over to a offer oven. What me and Ari like to use is this creative offer oven. The link to it will be right here. If not, the link to it will be in our Discord under the calculators tab. It should be this most top one right here. Now, I've already put all the data that I'm going to be using in my offer into this. I'm going to show you how I got that data. It may or may not be because I made this video 4 times and the audio never got recorded. But besides the point, Just starting off straight with the purchase price, how I find my purchase price. So for purchase price, we usually try to go a little bit over the listed price, not too crazy amount. Why you want to pull a comp on that property is because, for example, if this property is really only worth, you know, $200,000, I don't want to pay $400,000, even if their listed price is, 370, because that merely doesn't. It shows they're overpricing their property significantly, and it just would not be a good idea for a buyer or a landlord to buy that property, and it'd be much harder to move that property and disposition it. So typically with these type of properties, I try to stay below the 10% increase range. I could probably move this property, up to 430,000, 400, maybe $40,000 as a purchase price for the seller. But just for the video's sake, I'm going to keep it at that 410 number. Now, moving on to rehab. Rehab is another very big, important factor that a lot of people don't include in their offer. This could really be a make or break deal breaker. Why is it so important? Is, for example, if there needs $80,000 worth of rehab work, it's likely not a good candidate for a seller finance. Seller finance usually are going to be properties that are close or near to turnkey, and you merely do that is because every month they're going to be paying a monthly payment to the seller. So you want to have that property consistently being rented. Like as soon as you get the property, landlords they really just want to do a little bit of repairs and then rent it as soon as they can. So throwing $80,000 in 5 or 6 months, it's just wasted monthly payments that it could have been used on a different deal or a different property they're trying to buy. But for figuring out rehab costs, I like to bring this property over to Zillow and take just a quick glance at the property's photos. Key indicators of stuff that need to be fixed are going to be, backsplash, cabinets. Appliances don't look terrible; look fairly new. Why, you want to change the backsplash in the cabinets though, and any other like outdated stuff is because the majority of the landlords are going to be wanting to get fair market rent for this property. What in a perfect condition, what perfect condition they can get the property into. Now, for finding rehab costs for the property, what I like to do is I like to bring this property back over to Zillow and take a peek at the photos kind of provided by them. For finding rehab costs, you don't really want to go crazy for a seller finance deal. Why is that? Is because it's not going back on the market. It doesn't need to be a perfect, beautiful looking property. It merely just needs to meet fair market rents. So I'm not going to go crazy looking for, everything needs to be changed. I'm going to look at bigger ticket items like, the cabinets, the backsplash, maybe the countertops. The appliances look good on this property, but cabinets and backsplash, horrific. This is 1980s granny style stuff right here. And yet again, you're just taking a rough guesstimate of how much this stuff would cost to replace. It really just get a ballpark range because you're gonna remember some landlords are gonna put more money into it, some landlords are gonna put less money into it. So if anything, you kind of want to go a tad bit higher just to make sure you have a good deal, but don't overshoot it too much. A few other key indicators of this property would be, the bathroom needs a splash of paint. Definitely a new countertop and sink, maybe a new toilet. Again, look for not bigger ticket items for cosmetic stuff, but stuff like windows and doors. If the windows and doors are all rotted, it's definitely going to need windows and doors. If the roof is falling apart, it's definitely going to need a roof. Those are more structural items, but cosmetically, you're not going to go absolutely crazy for this. Yet again, these are going to be rented out properties. They're not going right back on the market. So you really just need to meet the par for standard, market rent and quality for that area. And that's essentially it. So for this property, I put a rehab of an estimating $10,000. If anything, it's probably a little bit high. It would probably be closer more to the to 7 to 8 ish thousand dollar rehab for the average investor. Yet again, though, it can fluctuate up or down. It really depends on who's buying the property and what they want to do with it and a long term goal for the property. Now, moving to cash and cash return on what it is and how it's more crucial part of the deal. The two biggest factors of cash and cash return is going to be your buyer's entry fee. What essentially that is the assignment fee, closing fee, rehab fee, and down payment mixed all into one. For this property, it's currently at almost 60,000. That buyer's entry fee and the monthly payment are going to be the two biggest factors of what really affects the cash and cash return for this property. But typically for down payment, I try to stay around under 15 to 12%. So I try to shoot for like 10 11-ish, give or take. This one, like I said again, really really bad monthly revenue, so I have to put the down payment very very low for it to even be an able deal. But just for future reference, you want to stay kind of around the 10, 11-ish if you can, if it's able to be done. Now, going back to cash on cash return, what is cash on cash return? The cash on cash return is simply how much they put into the property and what they get yearly return on that amount. For example, if I was to put $100,000 into this house, all said and done, I'd be getting, $10,068 why typically I try to stay above that 10% rule is everyone uses a good example of the stock market. The stock market's average return is going to be 8 to 10% on a yearly basis. Now, that's if you know what you're doing, obviously, and you have a little bit more insight and you don't know how to invest properly in the stock market. But usually it's around the rough yearly return that it gives back to you. And why you want to be over that 8 to 10% is merely because there's a lot more headache, a lot more overhead, and a lot more time you're going to be using managing these properties, especially if you do not have a management company doing any of the work. So yet again, for this property, 10.68 is honestly a pretty bad cash and cash return. It is Florida though, so it kind of depends on the market. But yet again, you always kind of want to try to stick to more populated areas when you're doing really anything in wholesaling. Now, for finding monthly payment, usually I try to split the monthly revenue income that the tenant brings in, the monthly rent. I try to split that in half, and then offer that as the monthly payment to the seller. Sometimes you have to lower it a good bit. If you can bring it up, that's good too as well. But usually you have to drop it a good bit to actually meet a good cash and cash return. But for finding the actual monthly revenue, what me and Aria like to do is bring this property over to a website called Zillow Rento Estimate. Now, what this site does, it shows you the current rent that is in that area and how much properties are actually being rented for in that specific area. So what you're going to do is throw that property in, type in a random Gmail, and once that's done, a Zillow estimate should come up. We always try to stick to the lowest number possible just so we know we have a deal. So it pretty much just tries to help mitigate wasting our time, wasting buyers' time, and wasting, obviously the realtor's time and destroying a couple of good relationships right there. What me and Aria do like to do though is scroll down, come to hide active rentals, click off that so the box is not checked, and then punch in the correct amount of bedrooms, and then scroll down. What this will do, or what that hiding active rentals will do, will hide all the ones that are currently looking for a tenant. So all these gray ones right here are ones that are currently rented with a tenant, and it shows how much they're actually rented for. So I'm going to shoot for around 26. And like I said, you want to be on the safe side. You want to be on the lower side. You don't want to overestimate and force a deal that'll just waste your time completely. So then I throw that number in right here. Like I said, I try to use like half of it for the monthly payment. This one, obviously, not anywhere really close to the half. It's more of a quarter of anything. Now, another bigger kind of thing that a lot of people miss is going to be the maintenance and the tax insurance and HOA on these properties. Typically, me and Aria try to shoot for a 15-10-5 or 30% for the maintenance, the management, and the vacancy. Why we do this is because most of the bigger investors are going to have a 15-10-5 rule. And pretty much what that means is 15% of this $2,600 is going to go into maintenance, fixing the property. 10% is going to go to a management company to manage this property. And then 5 is going to be a reserve for if that property goes vacant for a few months. Obviously, it definitely is going to depend on the landlord. Some people like to do 25% or 20%. Me and Aria just do 30 just to have a better offer for the niche group that does do that 30%. I mean, like I said, some landlords aren't even going to have a management company. They're going to be managing a smaller portfolio. They're going to be doing all the properties on their own, so they don't need to have that 10% in there. And that's just going to make this deal more appetizing for those smaller investors. Now, what I like to do for the insurance, property tax, and HOA is simply just bring that property back over to Zillow, scroll down a good little bit, and it'll show you the insurance, the property tax, and if there's an HOA, it'll show you an amount. Typically, it just says NA or zero if there's no HOA. A good way to kind of figure out if it does have one is simply just ask the realtor. Either that or check the description. Sometimes it'll mention an HOA or give a fee But the best way to really do it is just talk to the realtor representing their client. Now, what is a balloon payment? Another large factor of these deals. A balloon payment is essentially a few year long payment schedule that is like the property being amortized, or it is that property being amortized for that extended amount of period. And then after that extended period, the property gets paid off in full. For example, we have a property that is worth $100,000 with a balloon payment of 8 years. After that 96 months or 8 years at a payment of $500 per month, $48,000 of that property is going to be paid off. So there's a remaining balance of $52,000. Pretty much what that essentially is, that balloon period is just a time that the property is going to be given those monthly payments to the seller, and then the balloon pops, and the rest of the property is due to them. So however much is left after the monthly payments is needed to be given to the seller. Now, typically for balloon payments, we try to stay above 7 years. It's merely due to the fact that the market is going to change, and that's essentially why the balloon period is there for so long. We're waiting for the market to change, interest rates, specifically for the interest rates to drop. So typically, how the market works for homes is, I mean, right now, as of April 7th, 2025, it's way different. But typically, when prices of homes are high, interest rates are low. When interest rates are high, prices of homes are low. They flip flop. So what we're pretty much waiting for is a market reset, is what they call it, and for that to flip. So if we're at, for example, right now we're at like 6.5 or 6.7% interest rate from Freddie Mac. It's ridiculous. In 8 years, we're riding on the fact that that interest rate is going to be below that 6.5. It'll maybe be touching 4. Probably not 3, I highly doubt it, but maybe 4. Just what investors are using that balloon period for. Now, another insider, a little tip you could use. Some people put in their contracts if that interest rate has not dropped below the current rate. So, for example, in 8 years, if it's not below that 6.5, you have to continue the balloon period for another year. Um, that's merely just to help protect the buyer and give them a better, more motivating point to buy the property. Um, but it's just a little trait you could, or a little tip you could throw into your contract, though. Another important part of these deals is going to be agent commission. Assuming the agent's going to be pulling a 3% commission on these deals, a seller won't get that full $30,000 down payment. They'll actually be getting 17.7, which could be a big fact they don't really like. They're gonna have to pay agent fees no matter what. Don't get me wrong. But it could be a part that they're not too much of a fan of because instead of getting 30,000, they're now getting 17, which is significantly lower than 30. But moving forward, how I like to shoot over letters of intent to these realtors that I'm talking to with seller finance. I actually have a couple emailed offers that I've made in the emailed offer section in the Discord. With these offers, I always put a cash offer in there, as merely because 95% of the time, a cash offer will make you a lot more than a seller finance offer will. On average, a cash offer can be like 20 to 25K on a good deal. Seller finance is going to be around the 7 to 10,000 after closing costs and everything. So typically, I try to, or not typically, I always really try to put a cash offer in my emails I sent out to realtors. And it just it makes it more appetizing in a sense too. I guess it pushes seller finance being a better offer than a cash offer, because they've probably seen cash offers around that same price. So it's really showing how much better that seller finance offer would be for them. But on a slight chance they accept that cash offer, you have a very, very good cash offer given to them, and you're making the same, if not more, than you would on a seller finance deal. This is roughly how I structure my emails. As you can see right here, I have something called a deed in lieu of foreclosure. Essentially, what this means is that if we were to default on 2 consecutive payments, that property would be deeded back into the seller's name. A good negotiation point, as you could say, that realtors bring up in this, or an issue realtors may bring up in this, I've seen it firsthand, is that, what if the tenant trashes the property? Well, in that case, let's just say the tenant trashes the property, $11,000, $9,000 on the very high end. They absolutely trash the property, borderline burn it down. $7,000 or $10,000. Well, in this offer right here, or this agreement that we had that happened, they get the property back. They keep our $34,000 down payment covering that amount, They also keep our $800 monthly payments that we have been paying for however long amount. So really, they're getting however whatever the difference between that and the cost of the repairs from the tenant and the monthly payment. And then a new property that has also appreciated, assuming they trashed it in a few years. So they're getting a property that's worth more. They keep our down payment and they keep our monthly payments for free, and they take the property back. You could also include the fact that the buyer you're representing, or you, however you want to structure it, you have multiple properties and have bought multiple properties like this. You could prove it, and you've yet to default on any of them, and you've yet to have a tenant trash it where you haven't refixed the property. But essentially, this is how I structure my emails. Seller financings usually they take a good bit of time in negotiation with realtors. Just be persistent and have stupid confidence, and you should be able to close one.